the way we go about this, each panelist will take a few minutes to share with us information about his own background and the industry and the company that he works in. And Dr. Vanden Spiegel kindly moderates the panel discussion. Thank you.
So Ulis, could you start
Okay.
and give your views and reactions?
Well, I'd say my perspective is just from what I've seen on behalf of our firm and our clients. And some points that you made, I think, are ones to take away, that everything changes. And it's a global supply chain that we all participate in. To comment on Europe in particular, I'd like to give you a view from China's perspective, because we, matter of fact, over half of our employees of our firm are Chinese nationals. We've been in Shanghai since November 2004, and we've seen the change. China, you say, well, what's this got to do with Europe? It has everything to do with Europe because it's a global supply chain. We found that the movement of the development of a middle class in China has converted, in a real way, converted the world's factory into a consuming engine. And of course, Europe is China's leading trading partner. And so now we see it, when Europe has slowed, it has affected China. It's required them to provide their own monetary stimulus, and they came out very strong, probably stronger than the U.S. They were very committed, and now their rate of growth is probably 8%, they envision, which is a heck of a rate of growth. But again, what does it have to do with Europe? Europe is tied to China. Volkswagen just announced a big plant. They're going to the western region, an autonomous region in China. This last week, the China Investment Corporation, which is their sovereign fund, one of our first employee in China, works for them now. They basically, I think, Thames Water system in the UK, a major investment. So the accumulation of not only dollars by China, but the euro by China over the years, by selling to China, has put China in a major position to support the economy both here in the U.S., I think, and in Europe. So our perspective from what we see is that China is probably more important to the recovery or resolution of this crisis, both here in the West and particularly in Europe as we move forward.
Yeah. Hey, Mike.
Sure. Yeah. Maybe give a little bit of perspective on the labor market. So Manpower Group is a $22 billion organization, really focused on putting people to work, both temporary employment and permanent recruitment. And so we're in 80 countries, but the unique thing about us is about 70% of our business happens to be in Europe. So I'm not sure that's the mix I want right now, but that happens to be the mix we have. So we really see what's happening in Europe, and I would say, when we look at what's been going on the last, let's say, couple of quarters or several months, business in Europe generally for us has been slowing down. So we have overall about 300,000 people we have out on assignment every day working for our clients, and things are gradually slowing, as opposed to the financial crisis when fall of 2008 things just really hit bottom. Companies just stopped operating, stopped working altogether, and just really sent their employees home and said, we're done. We got to wait and see what's happening. Now what we see is a little bit of uncertainty, a little bit of caution. Our business is down in most markets across Europe about 10% against the prior year, but it's very, very, very slow go. And one of the interesting factors, I think, is there's a little less nervousness, at least what we sense on the ground today from our clients, than what it was 3 or 4 months ago, before there was any plan to solve the Greek issue. And I think with that came, okay, maybe there's some political strength and some political thought that Europe is actually going to work together and keep the union together and move forward. But certainly that has been a change. I think the one big difference as we look across Europe is Germany, which Doctor talked about, and there we've got a different problem in that Germany has been so successful. We have a hard time finding the skills in Germany to put the people to work. So we're a bit constrained to find the right type of skills and the talent we need in Germany overall to keep that moving. But one of the things that we see overall in the labor market happening is what we would consider a secular change in terms of how companies are managing their workforce. Overall, companies are very reluctant to hire permanent staff at this stage, particularly in Europe. And so as they look at how they're managing work, they're thinking about, should my workforce be 5% flexible, 10% flexible, 20% flexible? We're having many more discussions with our clients about what is the right complement, because we really need to get more flexibility into our overall workforce so that we can deal with what's probably going to be a much more rockier situation. And let's face it, given the political dynamic, companies just don't want to make any bets in terms of where things are going. So there's much more interest in flexibility, which of course helps our industry overall. And I think as I think about Europe, I think that's one of the big challenges that I see is the lack of flexibility in terms of once you hire an employee, to reduce or terminate that employee is just extremely expensive to do that. And really not competitive with the rest of the world. When you look at the cost of firing and terminating, you look at the cost of the social side of work. For example, in the U.S., for every dollar of labor, we've got about 15 cents of social tax on that. Many countries in Europe have 50 to 60 cents of social tax on that. So the social dynamic as well really raises their labor costs. So as we think about the world and think about the global economy, clearly it's a global market, and companies are competing for talent globally. You certainly see that, and which is really a big change we've seen in the last 5 years. And so I think that's one of the dynamics that we look at. We're concerned about is how does the world, how does Europe move from here to really become competitive with the other markets of the world, the other emerging markets, which have a lot of skill and a lot of talent that they're ready to offer. So just a little bit of perspective on the labor market.
Okay, thank you. Andy?
First of all, I just want to, Freddie did an awesome job in that 30 minutes, so I just want to have another round for him. Some of myself, I mean, I do this all the time as well, and his synopsis was so succinct and great. It's just, as a fellow presenter, I just want to say that was really fun for me to sit through. I also want to do a little self-promotion. You guys, do you know I have my own television show? Friday nights, CNBC, 4:30. Tune in, okay? We talk about this stuff all the time. We talk about international things that are going on, and it's wonderful that a university the size of Marquette has this type of program for you. You don't know how great this is. And you go around the world, it's hard to duplicate this at its size, so you get this immediacy. So this is great for you guys. I'm the bank's global currency and public policy strategist, so it's kind of a broad area to cover. But about 4 or 5 years ago, I was sitting down with my CEO, and my background is in currency trading, so we're always looking at dynamics of what's going on globally, how it's impacting currency values in the markets. And we agreed that we thought that the government was going to do a significant shift into the private sector. We saw the coming of the end of the Bush era in the United States, and somewhat laissez-faire, although it really wasn't. But certainly from a regulatory standpoint, we knew things were going to change, and we could see some dynamics coming on. I had no idea it was going to get this bad. I mean, government has really been on steroids since 2008, and they've made a lot of mistakes, whether it's the United States expanding its budget and its deficit to just catastrophic levels, which sadly for everyone in this room, you really need to be part of addressing this. This is beyond unsustainable. It's absolutely dangerous, and it will impact everybody here as far as the growth levels of this country and whether or not you guys have jobs coming out of school. So if you don't think your vote matters, you're wrong. It matters absolutely, and you should back the candidate you think is going to do the best job on that front, because it will impact you. So keep that in mind and do vote. With that perspective, I mean, I look at the financial markets mainly, but I also look at how politics impacts them. And as Freddie said, I mean, it's really now we've moved from just worrying about economics to worrying about how politics influences the markets. And he did a great job going through the housing crisis in the United States. You know, in my analysis of things that I look at, there are a lot of good papers out there, a lot of great research that's done. One that I would suggest for everybody read in this room is called After the Fall. This was written by Reinhart and Reinhart. It was presented to the 2010 Kansas City Federal Reserve Jackson Hole confab that they do. But it's great. It's about 40 pages long. Type that in, type in PDF. It'll pop right up for you. It's free. But what they do in there is they go through financial crises over the last really about 50 or 60 years and kind of give you averages of what's happened. So in a financial crisis that pops like we've seen in the United States in 2007, 2008, you have a 10-year period where you build up that leverage within the economy. Credit to GDP expands at about an average of 38%, and then it spends 10 years going back down the other way. So in the grand scheme of things, if you're looking at the United States and how that looks, we've ramped it up going all the way up to about 2008, and we're just starting to go back down. We're only about halfway there. So that means we're having more deleveraging going on, more consumers not spending at the levels that they were back in the early parts of 2000, and that means less economic growth. As you know, as students here, you know that the U.S. GDP is about 70% of consumer spending, right? So if they're kind of constrained, then the economy is kind of constrained. So you're not going to see these growth levels of like 5 or 7% GDP. You're only going to see 2.5%, 2% growth. As a matter of fact, on Friday, you're going to get a GDP number here in the United States for the first quarter. It should be somewhere around 2.2%. The point that I'm making on this is that if we look on average, right, real estate prices in the aftermath of a financial crisis drop 15 to 20% and really don't recover for at least 7 to 8 years afterwards. So if we're fortunate, 2007 is when the bubble popped, 2014, we still got a couple of years to go on this. And if we look at Europe, so if we're going to go shift from the United States to Europe, Europe back in 2008, they weren't the epicenter for the financial crisis that occurred. Obviously, it was predicated on what happened here in the United States. But they also didn't really address the problems that they had at that time, certainly not from the banking side of things, and certainly not with Spain. Obviously, they're somewhat of the poster child for housing crisis in Europe as they overbuilt, and now they're having serious problems with ever getting back to growth. So my belief is that they never addressed it in 2008, or certainly were trying to get through it. And that was a wonderful timeline of all the things that were happening negatively for Europe that Freddie put up there from 2007 to the present date. What I would add is this, is that this really now comes to a point where they have to make a decision on what they want to be when they grow up to some extent. Whether this is the French Revolution, I don't know. I thought that was another great example. I hope it's not 30 years. That would be rather depressing. Although I kind of like the Robespierre guillotine kind of aspect of it. But I think that they're going to struggle with this because they have labor inflexibility, as what Mike was saying. That's one of their major problems. You can't hire and fire people because it's so expensive in Europe. And that's one of their problems. They have a kind of a different social model or contract with the voter that has a huge social safety net. And that's a problem because you can't get people wanting to hire. You don't have that animal spirits to the extent that you do in the United States, and that's a problem for Europe. So my view on Europe is that it's going to continue to build on problems here because they can't get the growth they need. So growth is really key, not only for generating jobs and GDP, but of course for generating the key thing that all governments need, and that is money. They need tax receipts. That's the key, right? If you have somebody who's working and contributing, paying taxes, right, that's great. If that same person is not working anymore, all of a sudden they're drawing on government social services, it's the negative effect, right? So that's a major problem for Europe. How do you get growth? How do you do it? There's another really good paper out there called Expansionary Austerity. This is by three IMF guys. Again, type it in, pops it up. It's a little bit technical, but it basically comes down to the choice of what do you want to do? You either cut spending, right, or you either cut spending or raise taxes. Okay, if you cut spending, the downside to GDP is like minus 0.5%. If you raise taxes, it's minus 1.5% impact, downside multiplier to GDP. And that is the debate that's going to go on in this country right as we get into the election as well. Do we cut spending or do we raise taxes on the wealthy? Right? That's kind of the dynamic that's in play here. So you really have to ask yourself, well, what are we going to get for each one of those moves? And the same is going on in Europe right now. How do you manage that process? How do you get growth? Where does it come from? Because if you're in austerity, it's almost impossible to generate economic growth. So my belief is that the European Central Bank is the only institution out there that can do something. And they will. They will be forced to cut interest rates relatively soon down to zero and supply the market with a ton of money for their banks. If they don't do that, then I think the analogy to a revolution is quite accurate. Actually, I just wrote today, I write something every day on the financial markets and policy and politics. If you want to get it, you can just go to andrewbush.com and sign up for it for free. Doesn't cost any money. No one's going to try to sell you anything. What I would suggest is that today I wrote something that said rebellion in Europe, fiscal rebellion, because that's what's happening. That's why the government in the Netherlands failed. That's why you're going to get a socialist in France as their next president, is because the model that they've come up with can't work the way that it's structured right now. You can't have all austerity, meaning government cutting back and people losing their jobs. They're not going to take it for very long as voters, and they'll change whoever's there. So I think we're going to get more crazy towards this summer. Spain could be a flashpoint, 23% unemployment. The suburbs in France, out of Paris, I'm sorry, places where you have 50% unemployment for people between the ages of 18 and 24, it's rather dangerous. I mean, it doesn't take much to ignite this. So I would say I'm concerned about Europe right now. I'm concerned about a lot of uncertainty, but also social angst and anger that's going to be directed at the politicians shortly there. So that's kind of depressing. Sorry. But that's what I think.
Okay, thanks, Andy. Elise, you?
I have a question. Just you talked about the role of central banks, right?
Yeah.
Because the latest numbers are that the People's Bank of China is largest in terms of total assets, they think now, about 4.5 billion. ECB is the next largest central bank balance sheet in the U.S. What's the role of the central bank? We talk about the need, you got fiscal policy and monetary policy. You have to, what we've done here in the United States is to make sure the economy didn't stall, flooded with money. You just mentioned, Andy, Europe's going to do the same thing. What's the role of central banks as it relates to macroeconomics, but also to the politics?
Yep. And more specifically, the ECB, you mean? Well, the ECB is, again, in that whole political construction of Europe, is a very special central bank, which leads to the dream was, let's start with a single currency, and the political union will follow automatically. That was the dream of the president of France, Mitterrand, 20 years ago, and of Kohl, which was the chancellor of Germany at that time. Now, the currency is there, quite successful, well managed by the central bank, but the political union did not follow. And the treaty by which that central bank was created gives a very narrow mission to the central bank. They are not as flexible as Mr. Bernanke can be with the agreement of the government to suddenly say quantitative easing, I'm going to print money and I buy government debt to fund the deficit of the US. It's forbidden. Literally in the Treaty of Maastricht, 1992, it's forbidden that the central bank should help any country in difficulty. So this is where the political construction of Europe is not fit for a crisis. Because at that time, the puzzle does not fit in Europe. Now, in the meantime, of course, the former governor, which was Mr. Trichet, has then been followed up by Draghi, the new governor. In the meantime, they see that it's now 4 years of problems in Europe, and then they start to find pragmatic solutions. On the edge of the treaty, For example, what Mr. Draghi now is doing is saying, I'm not going to buy the government debt of Spain or the government debt of Greece. I'm not going to do it. But what I'm going to do is to give an unlimited amount of money to the banks and then trying to convince them that the banks buy Spanish and Greek debt. So this is the way Europe tries to get around of its own treaties, which are always bad compromises of a lot of politicians sitting together for weeks. So you have the two things happening in Europe. Try to muddle through with the limits of all the political problems, knowing that each of these politicians wants to be re-elected. Mrs. Merkel doesn't want to be the helping angel for Greece because she knows that her population, the Germans, don't like German savings to be spent to help Greece. They say they have danced the sirtaki for 20 years. It's not our savings that are going to help them. It's their problem. And the same happens in more countries. So you get nationalistic movements.
Definitely.
And there you have now the new French potential probable president, socialist, Mr. Hollande. It's not very clear. The French President Sarkozy and Merkel, they were a fine tandem. They agreed, and it was not because normally in Europe, the driving force is the European Commission. They propose things and they push. Well, this time, since the crisis, the European Commission is silent because they don't have any mandate. The crisis is not in their toolkit, so they can do nothing. And who has really moved in Europe is Sarkozy and Merkel. They have pushed everybody to do what they had to do. Now the question is with Mr. Hollande, what will now be the consequence? Personally, I'm not too worried. Well, I am worried. That is what you have heard. But it's perhaps not too bad to have an intelligent socialist as a president of France.
As opposed to unindulgent.
Those are not two words that are used in the same sentence, actually,
well,
for the most part.
If you look at the past in France, you had Mitterrand, who was an intelligent socialist, who partly has exactly done the opposite of what he promised to do. In order to avoid the social problems. Because for a socialist, it's easier to do the things that he would never do if he would not be a socialist. So perhaps we'll see what Mr. Hollande, if he wins the second round, which I think, what we will do, and that the tandem with Merkel will continue. In the meantime, the ECB is trying to do what it can. And the ECB has been very clear. When I talked about the triangle and the fact that weak member states get weak banks, that weak banks have to be rescued by weak member states, which become then weaker, and then you get the spiral. Well, the ECB has clearly said Europe has to recapitalize its banks. That's what the US has done in 2009. In a dramatic way, that's what Andy told, that Europe has not done yet. And that has to happen. That's the first step. Good news is that there is now 800 million euro ready in a new rescue fund that can be used or to help poor countries or countries in difficulties and to recapitalize banks. And my guess is that a lot of that money will be used to recapitalize the banks. Once that is done, then that downward spiral is stopped, and then I'm not so sure that there is no reason for more optimism for Europe. But there are a lot of ifs, and that's a problem.
Yeah, I got 5 in that last sentence.
Yes, that's it.
I'm not as much of an optimist. I mean, I don't think the solution for a debt problem is more debt. And I'm not sure that the IMF doesn't have the money quite yet because the U.S. has to agree to it, and that's not going to happen until after the election. As the U.S., you guys probably don't know, the IMF, to get any change, you got to get 85% of the members who pay into it to agree to it, and the U.S. has 17% of the vote. Unless the U.S. agrees to it, it's not going to happen. But what I'm excited about Europe is, and I'm just kind of curious, I mean, do you think, and I want to ask Mike this because he's kind of on the ground floor there, but what is cool about what's changing, I don't know if you can use those words in the same sentence, but there would never be these changes in Greece unless there was this crisis, right? they had a closed economy. It was like the people that had already, were in their privileged places, whoever had their licenses for the trucks, whoever had the license for a law degree, those guys were golden. It's everybody else who was trying to get into that group, you're shut out because they block you out via regulation, or you don't know the right person, or you haven't bribed the right person. Now that's being broken up. And that's what, to me, even though Greece is still quite a disaster, what I'm interested in asking you is, have you seen anything along those lines where people maybe, something dynamic could be going on there?
Mm-hmm. So I wish I could say we have. I'm not sure.
We're just a happy lot here.
I'm not sure we've seen that. I do think it is moving towards those who have the skills will get the work, and I think that is one of the things we're seeing, not just in Europe, but really every economy is a real bifurcation in the labor market per se, and that is another worry that I won't get into now. But clearly, those people that do have skills are very employable, and those that don't, we're finding along the sidelines. And I think if we see economies like Greece open up, have more flexibility, I think those people probably have a much better opportunity to get employed. So I think there is some possibility for that. One of the challenges is just getting that workforce up and get the low-skilled with the necessary skills, and that's not necessarily a 4-year education. In many cases, that's just a technical degree, some skilled labor training. Those type of skills are in need. They certainly are repricing because, again, we're in a global labor market that's competing globally, and those skills are repricing overall. And I think every economy we see, every developed economy is feeling that those jobs where I used to be able to make a good wage doing X, now I make a good wage doing, now I make a wage which is the good wage plus something doing the same thing, same type of work. So there clearly has been a movement, particularly in those less skilled type of jobs.
I have another question.
Yeah, please, Alice. Yeah.
Wait, Ulyss, you got to answer some of these.
I'm going to school, man.
Freddie, stop
This is
him.
good. On currency, we talked about central banks, but on currency, since that's your stick, right?
Sure.
So there was a lot of talk about, the potential of the euro blowing up, right? I mean, the risk of it blowing up. And the thought was if Greece goes down and Portugal goes down, and at the time Italy was a little rocky, stronger now, sounds like. But what's the potential impact of that happening? And for me, on the currency side, you talk about euro in the history and sort of the collage of the European Union. The fact that the British pound does not play is not part of the euro, right? It's separate.
Right.
And I remember, and I studied and lived in London a long time, the British in the continent view themselves differently. So how can you really have a solution in Europe when you've got two currencies, really major currencies, right? So euro and the pound. And you have some political and social, World War I, World War II, fought each other, still don't like each other to a lot of ways, right? I mean, candidly. So how might that affect the currency?
Well, this is a question that's running around the marketplace right now. Is like, for instance, could Germany pull out of the euro? I mean, that's one of the questions that I get asked. I just had an investment banker ask me that question today. And you have to understand that it goes beyond just, Germany's great and they can do whatever the hell they want, right? Because they're tied into Europe. Think about this for a second. We always talk about banks because banks are the funding mechanism for growth in Europe much more than they are in the United States. So if the banks aren't lending in Europe, it's a problem. You're not going to get growth. You're not going to get access to loans. But take a look at Germany. Let's say they went back to the Deutschmark. What would happen? First of all, their banks would lose a tremendous amount of money. So would many of the companies there. Why? Think about it for a second. Why would they lose money? They own stuff outside of Germany, don't they? Right. So if they go back to the Deutschmark and let the euro go, what do you think the rest of the people that are part of the euro are going to say? Happy days, let's devalue this sucker and see if we can grow. Right? Because throughout history, when you have restructurings or defaults, right, it's always the double Ds, right? Default and devalue. But you can't do that in Europe. because they're tied into the euro, the straitjacket there. The other thing that I would say, and maybe this wasn't part of Freddie's presentation, but Germany is a major exporter to the rest of Europe. Right? If you look at their growth rates through the 2000s, it is extraordinary for their exports. A lot of that did go to China, but a lot of it went to Europe as well. If you're in part of a union, right, where your competitors are tied to the same currency, they can't devalue, which is what happened in Italy all the time. I mean, I used to trade the Italian lira. It was awesome. They would always default to devalue, and governments would change. I think at one point they had changed a government in Italy every year since World War II. You could count on them. It was great. They'd change government, the currency would devalue, you'd make a lot of money selling their currency. But they can't do that now. So it's a different game because of that. So the Germans have a very vested interest in keeping this whole thing together. And remember, the big thing is it's a free trade zone. They've dropped a lot of barriers. They've harmonized some tax structures. They've harmonized a lot of regulations. It's in everyone's interest to keep this going. They just have to figure out a way to keep it going. And I'm not sure how that's going to play out. My theory is that the central bank has to ease dramatically. They have to allow inflation to go up because that's the only way you're going to get growth. And because you're tied to one currency, you can't devalue. And devaluing, that's how you cheapen your labor costs, isn't it? Because if you're in a country that devalues the currency, all of a sudden, labor costs in that country go down by probably almost exactly what the devaluation is. Now, with a tied currency, they can't do that, so labor has to adjust by actually the price going down overall. And that's pretty tough on the people. So the only way I see out of this is for the central bank right now, is the only central body that can act there is to cut interest rates and pump a lot of money into the economy.
Well, I do agree that the problems of Europe, of course, it's a political mess. I've explained that. I also said in one of the last slides, the euro collapse is not, I think, something that is probable. You should not forget, if you say the Greek problem, it's 2% of the Eurozone GDP. Bailing out Greece is almost peanuts. Portugal is less than 2%. Ireland is less than 2%. Ireland has already made the turnaround, is now competitive and is exporting. Portugal has made more or less the turnaround, but less convincingly. Greece is bankrupt. It has not led to the destruction. All analysts, and certainly all those in London, were saying Greece bankrupt and you have chaos in Europe. It has not happened because it's peanuts. You have to control it. What I think is the political willingness, despite all the unrest in a number of countries, the political willingness to continue with the euro is still there, for the good reason that Andy gave. It's not a win-lose, it's a lose-lose if you leave the euro, for the weak countries and for the strong countries. But what I do not exclude is that once the dust settles, that some countries will not be able or willing to play according to the new rules of Europe. One of these new rules is that a country can never ever have a deficit anymore. So for the future, if that is implemented in all member states, the problem of huge public deficits and debt will, to a large degree, be impossible in the future. It's all in the cards, but it will take a lot of time before it's implemented. But I'm rather optimistic for the euro. And then if you say, what is the future of the euro? Against what? Against the yuan?
Yeah, no, because basically you've got the dollar and the euro, and the yuan wants to get in there to make sure that it has a role, right?
But the future of the euro against the dollar depends as much about the future of the dollar. Right. And that depends on a political decision in China. Do we continue to support the dollar and to peg the yuan? Now, if there's a political decision to stop that, because to continue to accumulate dollars is a never-ending story, where the pain for the future becomes bigger and bigger, well, then suddenly you have another picture. Now, continuing on that, if you see that currencies and economies are so vulnerable on political decisions somewhere else in the world, what do you do as a manager? The times of just-in-time and the value chain optimize. What do you see in the US? Do you see already companies reflecting on, should we continue with that value chain worldwide and global, or should we protect ourselves against regulatory, political problems, and trying to get back part of the value chain in the U.S.? Do you see that?
What we see on behalf of our clients, and we're lucky to have some global clients, they say you fish where the fish are, right? So you look at Asia, the rate of growth, 8+, the numbers are there. India, $1.1 billion, China, $1.2 billion, $1.3 billion for some time. And so, the global supply chain moves there. Like we've got clients looking for, they call it the in China for China strategy now, right? So that's moving. And then as a result, some of our clients are tier 1 and tier 2 suppliers of the large OEMs. OEMs say, I made an acquisition there. If you want to keep supplying me, you've got to get there. And so I think ultimately that affects currency. If you look at the renminbi or the yuan against the dollar, it has grown stronger over the last 5 years, right? Not as much as people thought, but I remember 7 years ago it was 8-to-1. It's 6.2, 6.3 right now. And they've managed that. I think they managed it pretty well. So to me, I think there ultimately be three major currencies. The renminbi or the yuan is going to get there, mainly because they have so much of everyone else's currency. They can kind of set the game. Most recently, they just announced 2 weeks ago that they were going to allow the Bank for Reconstruction and Development at the IMF to now buy sovereign debt in China. Okay, as they're starting to open up their markets, you're seeing debt traded on the Hong Kong exchange now. Yep. So the goal is to allow their currency to become a top shelf currency. And I'm not sure ultimately the real effect of the oil being traded in U.S. dollars, right? I mean, to me, that's a subtle thing that will always keep the dollar a major currency.
Yeah. Okay. I would like to give you the opportunity to ask one or two questions if you have. Yes, please, you, sir.
Yeah. I have two parts questions. One is about Spain, and the second one is about big European banks. One, as you mentioned, their labor cost is a lot higher than Germany, and their unemployment rate is really high. And I heard from some people that they're expecting housing price would still come down more than about 30%. Do you see any threat of them going down in this year or next year? And is it even, are they too big to fail, or any other countries in Europe can even save them? And the second question is, would big European banks like BNP Paribas or HSBC, would they ever be able to reach their like 07 level with interest rate changes and things like that?
Yeah. Well, indeed, I mentioned already the problem countries until now are really small countries like Ireland, Greece, and Portugal. Spain is a bigger thing. There you get to something for which you need 1,000 billion as a wall of money to protect that country from collapsing. We are not there yet. There are very contradictory signs out of Spain. The housing market, most analysts in Spain think they are close to the bottom. It could come down a little bit, but they have already done the major part of coming down. Something that is now starting to be problematic for Spain is that a lot of exposure they have in Latin America, Brazil, Argentina, where these countries are now getting into protectionism, which could again hurt Spain. Until now, the general feeling is that indeed, if Spain would fail, there is enough money to rescue them for quite some time. But an economy of the size of Spain has to be able to do the turnaround themselves. And there you get into the social problems. It will not be without any pain. That's for sure. That's for sure.
The only thing I'd add to that is Spain has a really crazy fabric of levels of government that they have to change. They gave a tremendous amount of autonomy to the states, and it's caused all sorts of problems because I think there's like 5 layers of government workers that are overlapping each other with overlapping regulations. I mean, it's a disaster. So they have to change that, and they know that. They're going to try to pull some things back politically. Then I think, again, I try to be a little bit more optimistic than most people end up who cover this stuff, because if you really cover it a lot, you go home, you seal up the windows, turn on, make a little macaroni and cheese, seal up the windows, and turn on the gas, right? I mean, but I think there's some positive things that are happening.
Yeah. Yes, please, on the back row, and then we take the second question immediately after.
A question about China and how they're achieving such amazing growth when they're truly politically a command economy. So how is that working for them over the last 20 years? And to me, that tells me that really they're moving more towards a free market economy. And the United States and Europe tend to be moving more towards a socialist economy. So are we moving in the wrong direction and China's moving in the right direction?
Okay. And the second question, perhaps here in the middle, lady.
Unrelated, but what impact does the Eurozone crisis have on the international oil market, either in terms of supply and pricing, things like that?
Okay. So 2 questions, one about
I think Ulyss has to answer a question.
Yeah.
I mean,
one thing about China is that China works on 5-year plans. They just announced their 12th 5-year plan. So that's very fundamental, and yet the Communist Party, People's Party, governs China, but basically have a Politburo that says, here is the plan for the next 5 years, and they push the plan down to provinces and to the cities, and so it's kind of a controlled economy. But because they joined the WTO in December of 2001, there's an 88-page accession agreement where they had to begin to open up their economy, but they've done it in a managed way. So if you go to Shanghai and Beijing, it looks like New York skyline, but yet they've done it in a managed way. A big point about the most recent 5-year plan was called the Harmonious Society, because the concern is that they don't let everybody play. Everybody drink some of the water is going to be a problem. Okay, so basically there was a while there they said cities the size of Chicago, there were 8 new cities that size born every year in China. For the agrarian society coming into the urban market, TVs, now cars, automobiles, they're slowly, gradually allowing the middle class to grow. And whether they can manage it, I'm not sure, because typically human behavior is hard to manage. You can kind of make a move here and then wait to see what happens. So far, so good, but I think you're seeing now in the change, because again, every 5 years, there's a new president that serves for 2 5-year terms, okay? And so a transition is taking place at the end of this year, early next year. And as a result, you're seeing some prosecutions of elected officials, senior party officials who were laying kind of fat on the, on the lamb there, and now there's a change coming, and their support in Beijing is being taken away as new people come in. So there's a natural progression taking place, but to me, it's not a free market. They play as if there are a free market, but I think that the market forces of a global economy are forcing them to open up their system, and they agreed to with the WTO in 2001 that they had to make this move.
Okay. Thanks. Any reaction to the other?
As far as oil goes, it's a real strange market as far as oil. Europe is mainly determined by Brent crude, the price of Brent, and that's been impacted by a lot of what's happened in the Middle East. And Africa, obviously, with the Arab Spring, also with what's happened in Iran cutting off their supplies. So we have a spread of Brent to West Texas Intermediate be fairly high, and so you have higher oil costs there. In the United States, we have higher oil costs than what we did a couple of years ago, but it's a little different game. We have a tremendous amount of oil here. I mean, oil supply, we're awash in oil in the United States. Our problem as far as it driving gasoline prices, which I'm sure affects everybody in this room, is that there's a couple of things going on. It has to do some with regulation. It's really tough to build a new refinery in the United States. You've heard of NIMBY. It's damn near impossible to do it. Yeah, I mean, you're not going to be able to do it. And the other thing is that some of the refineries are older, and they're shutting down. And you get in this transition period. I don't want to get too much into this, but in the lead up to Memorial Day, you go from winter blends to summer blends, and gasoline prices almost always goes up over this time frame. Also in the east, in the United States, they're shutting down, a couple of the companies are shutting down refineries that got oil from Europe because the oil was so high and the cost of it, they couldn't compete with the oil that we're getting out of Bakken out of North Dakota and also from the tar sands in Canada. So this is really cool though, right? Oil production in the United States is amazing. Natural gas production in the United States is amazing. You know, it has really helped temper the cost to consumers, right? Electricity has been relatively cheap because of natural gas. Your summer electricity bills are going to be much lower than they normally would be because of how much natural gas is out there. And just real quickly, why has that occurred? Because of technology, which gets back to what Freddie said at the beginning of it. Technology drives so much of what's going on in this country, but hydraulic fracturing to release natural gas and oil has been a huge boon for consumers and for the production of oil and natural gas, as has horizontal drilling. So while you're hearing a lot of bad things about those things, let me tell you, it's fantastic because energy costs in production are so much higher and they're creating a lot of jobs and it's helping consumers overall.
Okay.
Can I get 1 minute? Can I get 1 minute? Just I'm learning. I'm going to school, man. I went to school here too, you know. So bringing it back. This room wasn't here back in the day. but on the natural gas, because right now you're right. Natural gas prices, I think they went below $2 per million BTUs for the first time in a long, long time.
Right.
But you talk about electricity. You have a lot of coal-fired plants around the world, right? That's where the carbon footprint's a big concern. But there's a lot of coal, right? So most times you'll see most power generation, electricity power generation plants are coal-fired, right? And so when you see the natural gas going so low, they'll start to convert those plants to natural gas-fired plants. But what about the coal industry, right? What about the impact on coal?
Obviously it's been negative, right, in the United States. Yet, going to where you do a lot of business in China, that's what we can pull out of the ground and send it over there. That, you know, it's a cheap source of fuel, and the Chinese have a lot of coal-burning plants. Now, that's not great from an environmental standpoint, but overall, you know, it's interesting how things shift around. You know, you're gonna see a lot more natural gas plants being built globally and in China as well. But this technology that I just talked about has not really, gone out as much as it has. Like in the United States, it's prevalent. For the rest of the world, they're just getting this technology. So I think from an energy standpoint overall, I think we're going to be in much better shape going forward. We burn natural gas. That's obviously a lot cleaner than coal. But I think eventually the price of coal has got to continue to go down and follows natural gas. And that's generally the way it works.
Okay. Ladies and gentlemen, I think we should close this discussion. At least here we can continue over there on this very optimistic note.
Yes, really.
So at least there is some optimism. Thank you very much to the panelists.